So for my project, I did a Markowitz portfolio optimization problem, which is trying to optimize stock portfolios or asset portfolios. So the goal of a Markowitz portfolio optimization, which is also called a mean variance optimization, is that you want to maximize the expected returns given a certain acceptable level of risk, or converse, or similarly, you want to minimize your risk given a desired return value. This is a very important problem in modern portfolio theory and is really what modern portfolio theory is based on. So when you give your money to a portfolio management company, this is what they do, and by learning this problem yourself, you can save yourself a lot of money. And the key numbers that this problem really outputs is your expected portfolio return, which is a measure of profitability, your portfolio standard deviation, which is a measure of how risky your portfolio is, and the Sharpe ratio, which shows you how much additional return you can expect per standard deviation. So the most common output of this problem is called the efficient frontier, which shows you the best portfolios. So if we see this curve, all the best portfolios are going to be along this curve or as close to that curve as possible, and all portfolios must be below this curve. And by looking at this, we can see what the best possible return is we could expect given an acceptable level of risk, or similarly what the minimum possible risk is given a certain return we want. So overall, I chose to look at this from the perspective of you want to minimize standard deviation given a desired return, and this is a constrained nonlinear optimization problem where your objective is to minimize the total portfolio standard deviation, which can be calculated as the weighted sum of the variances, and then take the square root of the variance to find the standard deviation. And then our constraints are that the sum of the weights is equal to 1. We want our desired portfolio return to occur, so the weighted sum of each individual asset is equal to the desired portfolio return, and each individual weight is between 0 and 1. Something else to note is that the expectation of each individual stock and the expectation of the total portfolio are stochastic variables. So in my specific implementation, I only consider the S&P 500 companies, although with the way I wrote my MATLAB script, I could easily change what companies I'm doing. I just did this for one model example. In addition, I used the capital assets pricing model. There are other models out there, and again, it'll be easy enough to change them. This is just one I picked because it's very commonly used. And then finally, I'm analyzing 5 years of data, and then I'm also ignoring companies that don't have 5 years of data since I didn't think they were statistically significant trends. So the steps I did to solve my problem are: 1, we have to write a web crawler to collect all the individual stock data for each individual company. So they do sell these data packages you can buy, but they cost like $200, and I don't want to pay, so I wrote a script in MATLAB to do this for me. And then next we calculate the daily expected return for each stock, and then from these returns we can apply the capital assets pricing model, searching for the beta and expected return of each stock. And then next we want to find the covariance matrix of the assets, which shows how the different assets are related to each other. Then we solve for the minimum possible standard deviation, which is our optimization problem, and this is going to be paired with our expected return. And then finally we construct the efficient frontier by solving for multiple points by considering different expected returns. So this plot shows the performance of each individual stock. So each X consists of a portfolio containing only one company. This is without any portfolio optimization. So here we've added the efficient frontier, which is this purple line, and we can see that we're really able to get much better return for the same standard deviation, or similarly much less risk for the same return. Here we can also see that this efficient frontier is slightly kind of linear and jagged. Ideally it should be a perfect curve, but I calculated mine with 10 points, which actually took about 2.5 hours to run. So again, ideally if you did this for infinity points, it'd be perfectly curved. But since I had 500 decision variables, this is a very, very long optimization problem. So I thought 10 still gave a really good idea of what the perfect portfolio would look like. So as a final example, I'm going to show how you can use this problem to solve a specific portfolio. So for example, if I want to have 8.5% return on my portfolio, I will solve this optimization problem, and that would tell me that the best possible standard deviation I can have is 3.72%, and that the best possible portfolio with that return is going to consist primarily of Hasbro, WholeLogic, Lockheed Martin, Sun Property Group. There are some other smaller constituents in there as well, but since I didn't really want to go in all these small fractional companies, I just listed these major ones.